Hi, Victor. Thank you for coming on this podcast series. And then Victor is the CEO or the co-founder of Bitcurate, very interesting data-driven insights to crypto forecasting. And he's joining us today to talk about flash loans. So hi, Victor. Welcome to this podcast series.
Hey, hi, Lisa. Thanks for inviting. Would love to be here and share more insights about the latest crypto analytics and DeFi movements to the world.
Awesome. Today we're going to start with flash loans. And before we get started, let's do a quick who, what, when, where, why, and how. So who uses flash loans? What are flash loans? Why people use flash loans? Where can you find flash loans? When do you use flash loans? And how are flash loans even used? You want to go step by step, or you want to go all at once?
No. I mean, you should go step by step, right? So that we can get into the flow.
Sure.
So a brief introduction about what flash loan is, right? Flash loan was introduced like this year, I think beginning of the year. And it was a new innovative product that was launched by Aave. So how does it work, right? Basically, the genesis and the simple gist of how flash loan is, right? Flash loan is essentially a loan that you can secure through smart contract from the DeFi protocol's liquidity pool. For instance, if Aave have a liquidity pool of, let's say, $1 million US dollar tether, USDT, and then you wanted to take a flash loan up to 1 million, right? You can do that. The only condition is that you will need to return that loan within one single blockchain, one single transaction. We call it as atomic swap, that you need to do it within one single block. So you go to code, you go to write that the scripts and the bot to actually get the loan and return the loan within one single block. That is the simple description of what the flash loan is.
So if that's the case, then how is it that, let's say we do a flash loan, you and me, and I give you $10, and once I give you $10, I'm expected to get $10 back, correct? That's exactly how flash loan works. So in that process, who is making money and where does the money go to? So I give you $10, you give me $10 back. That if you have the $10 in the first place, why are you borrowing it from me? And if the whole transaction is we giving each other $10, then what's the point of it? Because you still have to pay gas fees for these transactions, right?
Yep. Let me explain a bit further. So essentially, right, so imagine that you are Aave and then you have $1 million worth of USDT or any other stable coins in your liquidity pool. So that I, as actually a trader or an investor, I need to have a liquidity of $1 million US dollar tether from someone. So I go to you and I'm actually writing a script on a smart contract, and I will be borrowing that $1 million from you. So during this process, right, of course, I need to pay gas fees, as you're mentioning. And of course, I need to pay a transactional fees. I think from Aave, it's like 0.3% for 0.3 or 0.03. I've forgotten the exact amount. But if I were to borrow from you, when I return it, I'll need to include the specific additional percentage as well. But of course, now there are more players in the market for flash loan. But in any way, when I borrow the money from you, right, in flash loan, I am not required to provide any collateral. Just want to make it clear. For flash loan, I am not required to provide any collateral. As long as you have enough liquidity, I can borrow it. But in that process, I'll need to return that money to you within the same block. If I'm unable to do that, to return the same amount plus the fees that I'm supposed to return, then the whole transaction will be reverted back to its original state, which is I never actually started the loan in the first place. So that is how flash loan works. So I mean, what's the value, right? Generally people use it currently for two to three purposes, right? They're actually using it to do arbitrage trading, so that you can actually do trading without having your own capital. That is very powerful. And the second one is actually to when you're taking a leverage loan on like different platforms like MakerDAO or Compound, right? Sometimes you know that you want to swap different assets. So instead of you actually have to find some sort of collateral to replace the asset, you can use flash loan to do that. And then you can just swap it with using flash loan. So there are a couple of scenarios whereby traders and investors can use this mechanism, this tool called flash loan, to help them to fulfill certain requirement that they have.
So we go back to the point of saying that you said, I don't have collaterals, but I want to swap from, let's say, DAI to USDT, and I can use flash loan with that. in that case, am I not just using DAI as my collaterals then? Because I don't have collaterals to put up to be borrowing USDT, but I can swap DAI for USDT. That makes DAI a collateral in this flash loan swap.
Yeah, I mean, that is based on one-to-one, right? Sometimes people actually have leverage as well, and then sometimes they have an over position on different chain. So like I say, right, for example, I just use an example of MakerDAO, right? So when you're actually putting money in the MakerDAO and then you minted stablecoin and then you want to borrow, right? And then for example, during March when the whole thing crashed, you are literally required to find enough
liquidity,
Ethereum,
yeah,
liquidity, right, to actually putting back to your original state. So in order not to be liquidated, so having flash loan, right, give you an option that you can actually fulfill back the state without being liquidated, right? So that is actually a tool. That's why I say flash loan is a tool, right? It's a product.
Okay. And for people using it, like you mentioned, it's only arbitrage traders and these kind of leverage traders or derivatives traders. What about retail people? Is there any value add to these retail people?
Well, I guess that DeFi and flash loan is not really a very low barrier of entry for a lot of normal traders, right? I mean, put it this way, we know it ourselves, right? DeFi and the whole movements of like different kind of lending, borrowing, different kind of like collateralized lending and stuff. All of these are new. If you were to ask even a traditional finance person who actually have exposure to Bitcoin, they might not even understand or actually aware of how it works. Like for example, flash loan, right? So all these are actually created as a new innovative digital product that could only exist on a smart contract. So I think that is where the power is.
So that's actually a very interesting question, because can flash loan exist on non-blockchain platforms? So for example, can it exist on, let's say, Hashgraph, because they're also distributed ledger technologies, but not blockchain itself? Or can it be executed on any digital platform, so centralized ledgers? Because at the end of the day, if you think about it, we're not using the distributed aspect of ledgers. We're just using the electronic digital aspects with enough liquidity so that you can do your swaps and you can do all these transactions.
Yep. Oh, I agree. I think anything. I mean, we have to go down in depth, right, to look at the details of like the mechanics or the foundation of the protocol itself, whether they support it. For example, Bitcoin is hard because to execute a smart contract on Bitcoin network is actually I'm not sure whether it's doable, but it could be done on the L2 chain like Lightning Network perhaps, but on the core network itself, right, I'm not sure. I mean, the reason why it is happening on Ethereum is because Ethereum have a smart contract layer to it, right, which is the Turing complete Ethereum virtual machine. But on the traditional side, I'm not even talking about digital platform. Like, let's say, for example, if you think about from a bank perspective, of the traditional finance perspective, right, I think that is actually non-doable because there is always a counterparty risk to this part. And for crypto, right, the counterparty risk is actually slightly reduced because you actually hold your own key and your own wallet. That's the difference.
So I've been trying to match this with the real world example. And in the real world, you can technically do this because at the end of the day, you're just, like you mentioned, once you have the counterparty available, then that's why brokers exist, right? To be matching all these different people. So if your trade is big enough, you find enough counterparties to be undertaking your risk, you can do that. I would say that, maybe the only difference in the crypto space or to do it in a digital blockchain way is that it's instant, it's atomic, and we basically normalize all these business transactions with code, with smart contract logics. So
I agree. So it's kind of like digital, it's an upgrade to the tradition, which is why it's decentralized finance, DeFi, right?
And I guess that's where the entire value comes in. Now, in that case, then this seems to be quite risk-free because you're not putting up collaterals. It's atomic. Atomic means that if the entire transaction is executed or not executed. So if you can pay back the loan at the end, the smart contract can see that. If you can pay back the loan, it'll be executed. If you can't pay back the loan, then it's not executed. So it's risk-free. You don't have collateral, so you're not exactly losing anything. Now, it can't be just all butterflies and rainbows, right? Like, where's the risk coming from? Or are there even risks involved?
I mean, obviously, anything that comes with a risk, right? For example, the risk is actually more on the smart contract risk because it's code, right? And a lot of things that actually are done by programmers. To give a perspective, right? I'm actually personally myself, I'm actually learning to do smart contract programming. on solidity, right, to actually understand from the code perspective, the code level perspective, right, to understand really, when you're calling a wallet address from the smart contract itself, how is that impact on the network, or how is that impact on my own risk or my own wallet as well. So there's always risk. It's just about smart contract risk is one of them. And second one, right, I think the risk is actually on the market. So one of the biggest constraint right now on the DeFi, on Ethereum smart contract is actually the network speed. And of course, the gas itself, right? So one of the other one is actually when you are executing a trade, right? Yeah, we are saying that there's arbitrage trading. You can make, like I say, for example, $1,000 US. That is based on assumption, right? Because you're reading that from smart contract. You're reading that from the code itself, right? But what if when you exit the code, right? When you execute the code, right? Somebody actually do the arbitrage before you, and then they are paying slightly more gas fees, right? You lose your gas fees. So that is actually a risk in terms of like the whole process itself. So there are a lot of all these small little risks that not much people are actually understanding how it works yet.
Well, if the risk is only just losing your transaction fees, then that's actually quite okay, right? I mean, what's
depending.
how much is the risk for these transaction fees? Like 50 USD, 100 USD, but your trade are like in hundred thousands or millions, then that's actually quite a measurable amount of risk to undertake.
I think it's the same as high frequency trading, right? So imagine that you're running an arbitrage board to trade between different disparity between sort of like the basis point on like different financial instrument out there in the mature market, right? So, couple of basis point for them is like it's actually hard to make because of this, right? It's a little bit atomic as well because you're trading high frequency on the internet. So literally, sometimes when you lose that deal, right, you're talking about you are risking the exposure of like $1 million just to make that 0.1% of the trade, right? And then imagine the 0.1%, even though you have successful, but you'll be losing on the gas fees. So example, right? That is a risk to be considered.
That's true. I think the other risk can also be stackability, because all these different DeFi applications are basically like Lego blocks. You're just stacking them onto each other. So when we talk about smart contracts again, how these flash loans are being executed is that you say, I'm going to borrow $100,000, and in this same contract, I'm going to use that $100,000 on these different leverage apps, so that it can give me leverage exposure to Compound, to Aave, to I don't know, whatever, all the other things available, then get the returns, and at the end of the contract, return this $100,000 to whoever that I borrowed it from. So that's the entire process, right? But the thing is, now the risk increases because I'm not just relying on me borrowing from that person and returning to that person, on me just using that money or that tokens for some specific project or protocol. It's now spread across like 5 to 10 protocols so that I can get my maximum returns and be earning this risk-freely. Like how
I guess, right? I guess if you think about it, right, DeFi has mirroring what the financial system is when it comes to you're building derivatives on top of derivatives on top of derivatives, right? That's how it works, right?
Right.
That is what we interpret it. The only difference is that all of these are existing on a smart contract and it's borderless, right, as compared to like a traditional financial system, whereby it's actually blocked by countries and the different currencies. So that is actually kind of like the way I can see it happens, right? But of course, that being said, I think there are two observations here. The first observation is that we are assuming that there is not going to be a new innovation that is happening. To give an example, right, flash loan happened like 6 months ago. It didn't really pick up until now when people are looking at DeFi. And until now, if you ask, majority of the people in crypto, how many of them are actually aware of like the power of flash loan, right? I don't think actually a lot of people know, right? That is number one. The second one is actually on the innovation, like for example, credit delegation. That is actually a superb and very simple concept, but it's actually a crazy idea that actually just introduced by Aave. That has never happened before, right? And I believe that a lot of all these startups or a lot of people who are actually in crypto space, they are really good in creating stuff. A lot of things that when you look at it, right, all these products is going to be introduced in the market that we are not aware what is going to happen, and they're going to create a new spur, and then they will drive the adoption of the market. There are more people who's going to use different kind of tools to do money and go, right? Composability between different assets. The second part to answer what you were mentioning about just now is about the underlying asset. So there are actually some online tools and online SDKs and APIs, right, that whereby you can actually consolidate different kind of blockchain, different kind of smart contract to identify where the money actually is. Are they actually a leverage position into a different protocol while the asset is actually held by different? There are startups, right, actually in the world. They are actually doing that now. They are actually consolidating different smart contracts and actually trying to understand how the value is, where the money actually is. And it's really out there. The only thing is that somebody need to incorporate it together and put into their trading strategy.
So I guess we see that with year-end finance, we see that with kind of like curve finance, we see that with the Y vaults. There are a lot of things coming out together and trying to make this entire place a little bit more efficient. At the same time, it's very complicated. And the thing is, to get into the crypto space, in the DeFi space, is already a layer of complication. First, you have to understand finance. Then you have to understand technology. Then you have to understand some basic economics to understand how things work. And now we're going to have these like crazy, massively powerful, efficient products. And then it's like, poof, I'm lost. And it's so complicated that people are just struggling to get used to it.
You think about it, right? You are already an expert in this space, and both of us are actually kind of like we are in the front line of what is happening. And imagine that we are still trying to learn every day what is happening in the market. Can you imagine what is happening to the rest of the people not in this space, right? So, but that is where the opportunity is, I guess.
That's true. Like every day I just feel dumber and dumber every day because you can just never keep up. That's the thing about crypto. It's 24/7, right? It's like today you wake up and then suddenly there's something, like I think Uniswap or one of these protocols announced something while we were sleeping. So I don't know what happened. And then there's a bunch of new things happening right now. So when Asia is sleeping, US is awake. And then when US is sleeping, Europe and Asia are awake and everyone's trying to do something. My head is just trying to figure out how to stay sane. One thing, you talk about credit delegation, and I think credit delegation is it's so huge, it's so important, but I don't know why no one's really talking about it. With credit delegation, we're talking about 3 types of delegation. The first kind of delegation is, the friends and family things, because I have good credit. Like if you go to a bank and you have bad credit scores, you can't get your loans. But if you can get like a friend or family to sponsor you kind of thing, you can delegate your credit because you don't need that credit. That's going to be very helpful for that person. And that, to me, in economics value, I think that works because then you're allocating and distributing economic value to people who need it. So I think that's good. Then you have the second type of credit delegation where you are looking at, I have not really close friends and families, but people in general that I trust within my bigger circle, social circle, or my clients or someone that I have a social contract with, and then I can issue credit to them and they can be borrowing and then we can be doing business after. Kind of iffy. I think regulation needs to be in there, but good to go. And then something that I learned was that there's this credit delegation where you kind of just put it into the pool. I think you have it on Yearn or you have it on Y Curve or something like that. You just put it into the pool and people can kind of take your credit. So you delegate your credit to almost like random people so that they can be using their credit to be borrowing other stuff and then executing your whatever trade after that. Like, isn't that dangerous and isn't that like super scary?
I think that is where the innovation is, right? If you think about it from the perspective, there's always perhaps, right, one of the layers that to enable this, right, that nobody talking about it yet is like blockchain tracking, right? There are a lot of companies out there globally who are tracking on the blockchain and the addresses of the specific wallet, right? That actually to track what is the whether it's high risk or low risk, and that is just a start, right? That is just a credit score. Can you imagine that by using more machine learning, integrating with more data, right? For example, the pattern of this usage, the transactional of this account, and then adding more, right? How long have you been to this space, and then what kind of money have you actually put into the pool? I wouldn't be surprised if, let's say, for example, a blockchain company come up with certain predictive, right, and just to predict how is your personality, just like when you're on the Alibaba platform or Alipay platform, right? They're able to identify what is your credit score based on your past history and historical pattern. They could ask you some certain questions, right? You are able to provide your score online on the blockchain, whereby it's immutable, right? The number is going to be there. So that number is going to be public, of course, but you will be holding your own private key, right? So nobody can interpret what is actually that the address belongs to. But when you want to do the credit delegation, you just need to provide your account. And then the credit delegation will look at the information on that specific address and say that, hey, I think you're worthy and I'm going to give you that loan. for you to do whatever it is, right? And as long as you pay back based on atomic flash or flash loan or certain things, right, they're able to get the value out of it. I think all these things is going to happen. It's just that things is moving at a speed pace right now.
But that doesn't make sense because I am a good I'm a good person. I have good credit score. And now I'm delegating this credit to someone else that probably has a bad score. That's why they need credit delegation, or they need to borrow my credit. And then they're borrowing money, or they're creating flash loans or atomic swaps based on that. Isn't it dangerous then? Because now we're not doing KYC on that person. We're doing KYC on me. And then I delegate my KYC, or I delegate my good credit score to someone else.
I guess there will be certain rules, right? I mean, of course, I'm not looking at the specific details here. I think there will be certain rules, right, they need to fulfill. For example, they need to do it within one swap, right? Otherwise, they will not get it back. So there's over collateralization. And the second one part is actually, I mean, I can imagine that it's similar to the ICO space, right? Imagine to that, but the lower the risk of counterparty and non-custodial, whereby that the liquidity is in the pool. Right now, somebody want to take more risk in terms of not only for yield farming, that loan could be sent it out for some other people to do something else, right? Like, for example, I want to start up a new NFT project that I already have the project. I just need 24 hours to fundraise this like a Kickstarter, and I need something to kickstart it, right? And then I'll just get the liquidity from the people who are already holding it in the pool, right? So perhaps that it could be one of the use things like that right down the road.
That makes sense. What would be other, can this exist outside of DeFi? So one thing that I've been trying to think about is that when we talk about economic value in these kind of DeFi systems and DeFi ecosystems, there's a difference between nominal value and real value. Like, nominal value is just the kind of value that's been created. Real value is something that can be accounted for and you put in your GDP. So what we're seeing in DeFi space is there are a lot of experiments, good stuff, a lot of testings, a lot of test nets, a lot of trying it out, and people are willing to try and play with it. Some people earn money with it, good. Some are scams, bad. But in general, it's still quite experimental. And I would say that flash loans and credit delegation, all these things like you mentioned, it only started 6 months ago. So things are quite experimental, very fun place to be right now. But beyond DeFi, can this exist off-chain? Can this exist as a bridge between on-chain and off-chain? And can this exist in traditional finance?
I think the not even going down the path, right? I think the next step is actually looking on the interoperability. For example, right now everything is just on Ethereum, right? And we know there are a lot of mainnets, a lot of traditional older mainnets, right, such as EOS, Tron, Qtum, and Polkadot. And all of these are actually thinking about how we actually be part of this system, right, of DeFi. So they are going to launch their own crossover interoperability between different blockchain first. I think that is the number one. And then second one is that the consideration whether this one will go into another second level. For example, I know that there are certain protocols, right? They are thinking about off-chain, like you say, right? L2 networks, right? For Bitcoin, there's Lightning, right? For Ethereum, there's a different kind of chains that is in experimentation. A lot of people are thinking about that as well. But so many things that is happening in the technical space, right? To scale this operation. Like, for example, right? Another gap that I noticed, right? That people who are holding Bitcoin or people who are really, really into the Bitcoin movement per se, right? Bitcoin maximalists, right? They're actually not participating in the whole DeFi yet because there's not much of an option. It's very simple. There's a bottleneck. What is the available for you to wrap your BTC into Ethereum? There's only like three. REN BTC, WBTC, and another one I forgot. PBTC.
PBTC.
Yeah, there's only three. And think about it, right? How the Bitcoin maximalists itself, the big people holding Bitcoin, you'll be wondering whether they can trust this network because there's an offline custodian to it, there's a node issue and everything, right? And imagine that, how big is that? Because Bitcoin is one of the biggest digital asset right now, right? Could we even get like 5% of them to actually adopt to crypto, right? I know it's just started, but a lot of gaps, a lot of things to be solved, right? And DeFi has just started. That's number one. Then the second one that you're mentioning, whether you can go to traditional finance. I think we shouldn't mix them both. I'll use the analogy, right? Until today, right, there are still people reading newspaper and magazine. It's a bad business to be, but they are, right? They are still people who are reading newspaper. It's just that it's not a fast-growing business. So if you ask me, the traditional finance will be the same as well. There will be people from a different needs and different perspective. They will still need to have the traditional finance to do their stuff. It's just that there will be an emergence of a new category for the next decade, 2 decades, right? People will be thinking that, hey, I would rather hold Bitcoin. I would rather do investment on my DeFi than actually putting my money into the traditional finance. I think that is the one that is going to grow the market.
Can it be used outside of DeFi though? So within crypto, but outside of DeFi. So I don't know, NFTs, games, video games, electricity market, trading, not money trading, not financial trading, but like other types of trading.
Are you referring to flash loan per se, or
Correct.
are you thinking about the
like flash loans?
I think you can because it's on a smart contract. I mean, just to give you an example, right? I also play games as well, right? So this is one big bottleneck. When you play some online multi MMORPG that you are playing with people, there are certain stuff you want to trade, right? Of course, there's online in-game currency, but generally on the network itself, right? A lot of people are actually trading with real money using PayPal, using different kind of payment methods, right? Imagine that, and then of course in the crypto world, there's NFT as well, right? So things will actually progress from there. And then when it happens, right, I'm sure the digital generation will be like, hey, could I, the item that you are actually trying to send to me, could I have a custody on smart contract? And then I'll just take a flash loan to repay you, and then I'll just resell it to somebody else within one atomic swap, and then I make money. Isn't that arbitrage trading, right? That is the same thing, except that it's on a different instrument.
Oh, that's interesting. Is that, but that's not the culture for gamers, right? Like for gamers, you just kind of play and collect. I don't game, so I feel like when you game, you just kind of want to collect all these medals and armor and stuff, and you don't really want to sell them.
There are actually there are always economics behind the game market. It's always there. You know that, for example, I play a mobile game called Clash of Clans. That was a couple of years back. I remember that a lot of people are actually selling the account. I mean, of course, it's against the game publisher, right? They cannot be selling the account, but it happens. A lot of people are selling game accounts right after they reach to a certain level. They wanted to sell off just to recuperate their own cost of spending time and money to the game. And there are some people who are lazy to actually start from zero. They'll just pay somebody to buy the account and then they'll continue to play. A lot of games have that.
Then could that also work for all these, credit delegation? Because with credit delegation, you're not exactly doing KYC on the individual, you're just doing KYC on the wallet. So I can accrue a lot of like good credit score, then I sell my address to someone else and they can be just using that. It's almost like a video game in real life.
Yep. If you ask me, that is possible. I mean, those are the ones that I was talking about, right? I mean, that is how your credit score is. Maybe you actually have a certain items on certain games or certain virtual items, right? It's worth something. For example, CryptoKitties, right? There's a market value to it. That nominal or market value depending on the terminology. But the point is, in CryptoKitties, I remember there's people actually bought some one version of the specific kitty that is worth for like $100,000 during then, right? I mean, it's worth 100,000. Somebody is willing to pay for it. And imagine that if this were to pick up, that is actually endorsed by real people in the real world, or even on the online space, right? Some people is going to pay for it. As long as demand for it, right? I mean, it's the same as any other cryptocurrency. If there's a demand for it, I'm sure that there are people going to make money out of it, and that is where the digital finance and decentralized finance would come into the use.
Oh, thank you very much. I think if I can summarize what flash loans are, is that you set an input, you set an output. So the input will be, I'm going to borrow 100,000 DAI. The output is I'm going to borrow 100,000 DAI. And in the middle, I will allocate this 100,000 DAI to like 3 other protocols. And if I get X% returns, then the smart contract will see if that's possible. If that is possible, then it will be executed and you'll get whatever you tell the smart contract to do. If it's not possible, the smart contract wouldn't execute, but you still have to pay gas fees. So in that way, it's risk-free. Yeah, you just risk gas fees. That's it.
Yep. So which is why flash loan is a very powerful tool that not much people are actually talking about it yet.
Okay, what must you know before you can start executing a flash loan? Like, must you be a developer? Must you be a programmer?
Depending on the use case, right? I will not go down very much into in depth because I really spend a lot of my time and money to actually learn this. But I'll give a very high level of what the use case, right, and how to execute on it. I mean, there are certain tools out there. There are people actually created, right? You can actually stack different stuff, inclusive of a flash loan module. Like for example, I think another one called I've forgotten the name. Right? There's one tool out there. Right? You can Google for it. Right? It's like a money Lego block. You can actually assemble based on different protocols. Somebody did that, right? But that is not enough. Why do I say that? Right? To get the flash loan itself is okay, but for what purpose? if you were to get a flash loan, let's say, for example, to cover your position into that loan, right? That one you can do anytime. That one is easy, right? But if you were to use flash loan for trading, trading is about first come, first serve basis. The one that are able to execute this before everyone else, they call it as front running, right? If you can do that before somebody else, you make the money. The one that comes after that will lose money. Or they were not unable to make the money, right? So everyone is going to compete on the same piece of pie. So that's why, if you ask me, nobody is going to talk about it, because why am I going to tell my secret to other people how do I make money, right? So that is an example. But there will be more use case coming up soon. I'm sure of it, right? Because why? Every other protocol, the good ones, right, will be thinking about how do they introduce a good product to encourage more people to create value in that system, right? Which is why the credit delegation is, that's why the flash loan is. The flash loan that we're talking about today is actually the flash loan 1.0. I already know that there's somebody doing flash loan 2.0 that actually is a limitless flash loan. Somebody actually announced it on Reddit, and I did a video on it. We actually watched the video. You can literally borrow unlimited amount of money in a flash loan. That is how crazy it is. In the financial world, that could not happen. But on the crypto world, that is
everything goes
to be done. Because it's everything on atomic swap. Either it happens or it don't happen, right?
That's true.
It theoretically could be done. But whether people will adopt to it or not is a different thing, right? It's very interesting. I'm very excited to wake up every day, right, to look at the possibilities of what are the new ideas, what are the new innovation that people introduce on the DeFi space and stuff. Like we know that we have Rebase, we have Flash Loan, then we have like AMM with bonded curve. Then there's one launched today. It's called Dodo. You know, I was just reading in the Twitter before this meeting, right? They are talking about progressive MM, I think PMM, another new model for the equation of like constant, right? So many things is happening. I'm kind of very excited, but also very nervous. Every day I'm going to miss out certain goal.
Totally get that. Okay, so before we end, just one last question. If you can give one advice to all these economic designers or token designers, what advice would you give?
I think the first thing is that depending on this person, my advice is this, right? The first thing is to learn the code, because a lot of people talk about it. I mean, in a sense, right? For example, yourself talk about it as well. I mean, you are one of the senior ones, but a lot of people who are actually in finance, right? They are not really understand how it works. In the code world, right? There's a lot of things that could be imagined and could be done, could be executed, but you need to understand the constraint of the code itself, right? So that is why I wanted to venture into that, so that I know what is actually could be possible and what is not possible. So that itself is actually the first fundamental layer. The second, of course, as you mentioned, right, somebody who actually try to understand this need to understand like the economics, the tokenomics of the basis of it, right, the mechanism, and game theory, for example. But the fundamental layers still need to be on the code. So if you are able to understand that, you're already way better than a lot of people in terms of like understanding DeFi.
Thank you very much, Victor. Is there anything else you want to add?
No, not really. So that I would just say that I'm glad to be a part of the DeFi movement and share more of my insights and ideas. Right. I mean, that is the reason why I'm here, not just because of to make money. Right. I think the most important thing is to be part of something meaningful and grow and try to make some money out of it. Right. But trying to be something progressive and innovative is actually much more important to us, for us, right? Especially in this early adopter for decentralized finance or DeFi.
Thank you very much, Victor. Thank you for joining us.
Goodbye.
Goodbye.
Bye-bye.